Hey, everybody, it's Steve, your multifamily specialist here, 570-798-7051. You see that um, I'm involved in a lot of different things. I run the Real Estate Community Network, which you guys found us on, Hunting for Homes, REI Post. I'm a realtor with EXP. I am certified by multifamily specialists. I'm certified by the National Commercial Real Estate Association. I'm certified as a certified real estate investment planning specialist. So I've been around this business a little while. This is the first of our weekly presentations where we're going to give a little bit of insight on how to evaluate and how to manage and how to handle multifamily and investment property, how to look at some things. We do meet the second Wednesday of every month live at King's Pizza in Mountaintop. I do have to throw out the disclaimer that EXP has nothing to do with this. This has nothing to do with me as a realtor. This is simply me as an investor trying to share some of my knowledge. So we're going to take a jump over to my screens here and look at this particular property, which is a great double. It's this green one here. Didn't do such a great big job with the picture, Steve. Okay, fine. Anyway, you can see from the photos that the property is in terrific shape. Comes with the empty lot next door, completely renovated. This place was gutted to the studs when I first saw it 3 years ago. So you're in really good shape condition wise with this property. Getting back to what matters is in my work as an investor, my work as a realtor, I'm going to tell you that comps matter because they do. Banks care about comps on two families. It's pretty much the only thing they care about. They only look minorly at the income numbers. Appraisers, blah, blah, blah. But for me on a cash flow purchase, what am I buying? The old adage that I used to give is if you can buy a 2-unit in a city like Wilkes-Barre for $100,000 that makes $1,500 a month, and you can buy a 2-unit in Dallas, PA, an upper crust suburb for $200,000 that makes the same amount of money, which one do you want? Well, if you're going for cash flow, you want the one that makes 100,000 because you're making the same money for half the investment. Your cap rate will be higher. And just for so you all understand what terms we're dealing with here, cap equals profit over the dollars in the door. I mean, the dollars spent to buy the deal. So looking at it differently, your cap rate, we'll keep it simple. If you profit 10K and you spent 100, your profit is 0.1 or 10%. If you spent 200 for the same deal, all of a sudden it's 5%, 10 divided by 200. Now, if you leverage the property, you're not talking cap rate at that point, you're talking cash on cash, which means let's say you make 3,000 net after paying your mortgage, and I'm using a crazy high number, but just go with it. And you've got 30 into the deal, then you have a cash on cash of 1, 10%, 0.1, 10%. Usually you'll do a lot better on cash percentage wise because the bank is putting up 80% of the money and you're not spending 80% of the profit to pay your mortgage. So cash on cash is if you're using leverage, but it's still profit over the dollars out of your pocket. It's the same thing, it's just called something a little bit differently. So cash on cash cap rate, quite similar. And we use a slightly different valuation here. If the profit is 10K and I want 0.1, which is 10% cap, 10K divided by 0.1 tells me the property's worth 100 grand. And that's to me finished after I've made the repairs. If it needs a lot of work, whatever. And I take out of that my repairs. But basically, it's still profit, cap, value. Or the exact same formula, cap equals profit over value. This is basic algebra, guys. I know it's new for a lot of folks, but it's not hard. Remember that cap rate has the same thing. As the cap rate, you move the three around. I'm doing a bad job of explaining it today. I'm sorry, but you move the three around. Cash on cash is profit over the money you spent. Real simple. So just so we don't get lost in our terms. The other two terms that we use are NOI and AGI. AGI is rent, total income, minus total expenses. Raw number. The rest of the world calls this NOI. I don't. I call it adjusted gross income. Because what's not in here is maintenance vacancy management. NOI, or my NOI, is AGI minus my maintenance vacancy management pad, usually 15-20%. So at the end of the day, if I'm looking for an investment, I want to make sure I take into account my maintenance vacancy management expenses, at least what I predict them to be. And here's the old, hat trick. Here's the old rabbit out of the hat. When I am listing things as a realtor, I am using this number. When I am buying things as an investor, I am using this number. As a realtor, I'm going to tell you rent minus hard costs. I'm not going to tell you what your maintenance pad should be. It's not my job. That's up to you. You're the buyer. When I'm the buyer, I know what I use. That's what I use. That's what I found to work for me. So when a realtor tells you NOI, this is what they're telling you. When a seller tells you NOI, this is what they're telling you. When I tell you to calculate with NOI, for me, NOI is after the maintenance pad. So let's put this into real world terms again. Let's go back to the screen. And let's look at what this property actually does. This property actually, which we just found out last night, it's got revised numbers. They're better than they were. But it was $2,200 a month. And you can break down all the costs here. Any good realtor, any good wholesaler is going to give you all the numbers real simple. 23.2 minus 18 minus $5,000 brings you to 18.2. Boom. Done. So how that looks in reality when you go deeper on it is here's what we have. We have 2,200 rent, other income, laundries, parking fees, whatever other things you might have in your property, other income gives you 2,200 a month, gives you 26,400 a year. Very simple. This is adding this is adding those two together. This is multiplying that by 12. This is adding those two together. This is a year's worth of that. Real simple. Here's our taxes, here's our insurance, other expenses, garbage, and inspections, basically, in this particular case. 5,400. So 21,000 is your adjusted gross income on this property. Maintenance vacancy management, I'm using 20% for my maintenance and vacancy management number. And that's 5,280, which means my NOI is 15,720. And just to make it easy, this sheet has AGI is A minus D, column A minus column D. Okay, fine. B minus E, but same thing. NOI is AGI minus MVM. So we have 21,000 before maintenance vacancy management pad. All of these are before your mortgage. I'm not doing your mortgage here for you. I'll show you how to do it, but I'm not going to really do it tightly for you. 21,000 is your hard income, hard expenses number. 15,720 is after your maintenance and vacancy management pad. Now, let's say on the hard number, the AGI number, what everyone else calls net operating income, I want a 13% return. Great. So if you look up here, you'll see H2 minus I7. So AGI, I'm sorry, divided by I7. AGI divided by 13% tells me this building's worth $161,000 to me at my valuation prices, if I don't take into account maintenance vacancy management. NOI value, as an investor, I use a lower cap rate. I use 10%. So 15,720 turns into 157,200. And I'm sure you're all sitting out there saying, wait a second, Steve, why are you selling something for 275 that you as an investor is going to say it was only worth 160 to 160-ish? Well, because this building has more intrinsic value, because it is gutted to the studs. It is brand new. Everything is less than 3 years old. You won't, and it comes with an extra lot. And truthfully, we're selling this aiming at an owner occupant, or aiming at a New York investor or a real estate investment trust that wants a lower return, that they want a better property for less, for a lower return. Because you've always got to remember, there's two trade-offs that go almost consistently in real estate. I know this is going to blow your minds, but if the quality goes up, the value goes up, and the cap rate goes down for a given income. Your income stays the same. Meaning, I'm making $2,200, but I've got a building that's less than 3 years old with everything brand new. It's worth more than a building that wasn't gutted 3 years ago, that wasn't down to the studs, that we don't know every piece of wiring and every piece of pipe in the building is brand new. And if you're going to pay more on the same income, you're going to have a lower cap rate. The other amazing shocker to you is going to be that as the appreciation goes up, or the true value goes up, the cap rate goes down. Meaning, if you're in a market like New York City, Boston, LA, so on and so forth, where prices could go up 20, 30% in a matter of a couple of years, your property could legitimately easily be worth double in 4 or 5 years. Those markets aren't giving you 10, 12, 14% cap rate returns. You're not getting the return on investment on a cash flow basis, because people who own them know what they have, and they're not going to let them go cheap because they know in 5 years it's worth twice. So if you're in an area where high appreciation is high, your cap rate's going to be low. I always describe it like a seesaw. You've got appreciation and you've got cap rate. As one goes down, one has to go up. But at the end of the day, what we're looking at here with this particular property is we're looking at, it's a really special property. It's been really well renovated very recently. It's intrinsically worth more. Now it's actually making a lot more money now too. It's making like $1,300 a month for a site. So that's great. Everything is separate. Anyone who buys this will not have a problem being able to, worry about maintenance basically. So I'm going to take these two here and I'm just going to push them up a little bit because I need a little bit of room to show you the last part. So if we're taking clear money, we're taking $15,720. Now let's just take and say $3,000 a year in mortgage payments. So here's my AGI, here's my mortgage. So $12,720. And this is my cash income. Let's say 4,000 a year, just to be fun. $11,720. Now, and I know this is getting a little complicated here, and I hope I'm able to explain it well, because I really didn't prepare to speak on this topic today, but $275,000 times 25% down. You're putting 68,750 into the deal. So if I take the cash you get in your pocket, 11,720, and I divide it by the 68,720 you put into the deal, you have a 17% return on your investment. Now, there are very few investors that are going to look at you and say they don't like making $17,000. Now, you'll also notice that I'm not doing 157,000. I'm doing the asking price. Now, just by comparison, if I take 15,720 over $275,000 on a cap rate valuation, apples to apples, this property at its asking price makes 5.72 cap rate. Again, it's worth intrinsically a lot more because of what it is. However, that 5.72 cap rate shoots up to 17.05% when I leverage with the bank. One of the reasons you always want to leverage. I'm not taking into account depreciation. I'm not taking into account any tax benefits, any 1031s, any federal opportunity zones, any of that stuff. I'm not segregating my costs on the redevelopment. I'm not doing any of that stuff. I'm simply saying $275,000. Well, actually, my pocket money is 68,750 divided rather into my profit. I'm taking 11,720 divided by 68,750. Now, just as another example, $157,000. So I'm going to spend $40,000 on my down payment, and I'm going to make about $10,000 a year. So I know you're all going to be shocked about this, but 10,000 over 40,000 gives you 25% return. So on this line item right here, if I took all the $157,000 out of my pocket, I make 10% return on my money at this property. If I leverage it, I make 25%. Now, the beautiful thing you'll see is there's not a lot of difference between paying $157,000 and paying $275,000 because I'm not taking that much more out of my pocket. So really, if you're leveraging a property, your cash on cash return, the amount you're making on your personal money, can remain very high, even if you pay more than you necessarily want to. I'm also assuming 25% down, which is fairly high. So basically, when it comes to figuring out what a property is worth, you take the rent and all the income minus all of the hard costs, and that's what I call AGI, adjusted gross income. That's what the rest of the world calls net operating income. I like to take out maintenance vacancy management pad and leave myself with this for NOI. Either way, I take my profit, divide it by my cap rate, it tells me my value. My profit on NOI divided by my cap rate tells me my value. Cash on cash return works exactly the same way. Profit divided by money out of my pocket tells me my rate of return. Or profit divided by rate of return would return the same thing. For example, well, profit divided by rate of return would return the same number. Cash on cash, cap rate. The math is the same, the words just move around. This is how you determine, in my opinion, whether a property will be a good investment for your family. The last way people do it, and this is very popular for those of us who are smaller investors, is real simple. Most of my investors tell me, if I'm not putting 100 to 200 plus per door per month in my pocket, I'm not buying the property. Which means if they're cash on, to double, it's a two-family house, cash on cash return, it's going to return you $11,000 a year. It's going to return you $1,000 a month in this theory. $1,000 a month, 2 units, $500 a month profit. My investors are happy at that. So, like for me, I eat my incomes. That's part of how my family pays its bills, is by the rentings. So I have X number of units. I make $200 a month per unit. I have $200 times the number of units. Great. I got a dozen units. I make 200 a unit. I got $2,500 a month. Great. So that's 3 ways to calculate your value. This spreadsheet is mostly what a bank is going to want to see. They're not going to worry about your dollars in your pocket at the end of the month. They're primarily going to be focused on your cap rates. In the next session, next couple days, we'll get to debt service coverage ratios and things like this, but this covers how to calculate cap rate. And again, cap rate, cash on cash return, they always calculate the same way. Is your percentage, which is your cap or your cash on cash, equals your profit over your value, or value is the wrong way to say it, over the money spent. Any other questions? All right, please give me a call, Steve, multifamily specialist, 570-798-7051. Thanks.